Hi, everyone, and welcome back to the Wealth Clock with Steven Weinstock. I've been investing in real estate for over 20 years, started off with single family homes, moved on to multifamily properties, and recently launched my own real estate investment fund. This is a show where operators, founders, closers share what really works in real estate and in business. This episode is sponsored by my company, We Capital, and the Goethals Capital Fund, where we buy properties in cash. We eliminate mortgage risk upfront. We lock in some deep discounts on the purchase, and then we refinance in order to scale. Today, I'm excited to sit with Bryan Morris, founder of Seven Peak Capital, a private equity real estate firm that helps high income professionals build passive income and financial freedom through multifamily investments. What makes Bryan's story unique is that while he's running Seven Peak, he's also spent nearly a decade as a top performing enterprise sales executive at Salesforce, where he manages strategic banking relationships. His real estate journey started back in 2016 with a single family BRRR deal, BRRR. For some of you who don't know what that is, we'll get into that. Funded partly with the Lowe's credit card, and he has since scaled into multifamily and private fund structures. Bryan, welcome to the show.
Thank you, Stephen, and thank you for that intro. That was a hell of an intro there. I appreciate it, and I'm excited to be on and talk to you today.
Okay, first, since I was in the intro, just tell us what BRRR is. It's a famous online, everybody knows what BRRR is, but maybe not everybody listening. What is the BRRR method? BRRR, and there might be a few R's that I'm
Yeah,
missing. But what is the
yeah, I
BRRR
think I
method?
lost ours. I think there's four, but it's buy, renovate, refinance, rent, and repeat. So the simple analogy for buying a house that's needs some work. And so the first R would be renovate, and then you're going to refinance it after the renovations has gone up. Then you're going to put a renter in. Then you're essentially going to repeat that process.
Got it. And you did that with a Lowe's credit card and I guess
Yeah.
some small down payment on your part?
Yes, luckily this was in Pennsylvania. I'm from Bethlehem, Pennsylvania, and this was in 2016. And this was a month or two after reading Rich Dad Poor Dad, which I feel like is the typical start for a lot of multifamily or real estate investors. And it's this epiphany of I should buy a rental property. And so that's exactly what I did. I was living in Harrisburg at the time, working for Pepsi. And I had some savings, maybe 15 to 20,000. So that property in itself, we identified it was a pre-foreclosure property that was listed for 88,000. We found it on market with a realtor and was able to get it under contract and actually put 20% down. And I think total closing down payment and closing costs came around $20,000. So it wiped me for everything I had, but hey, I had my first house and I got started, right? So then I was like, now how the hell am I going to buy materials to flip this thing? And that's where the Lowe's credit card came in. And it was about 12 to $15,000 in renovation costs, but luckily my dad's a contractor, so we put in about 8 to 10 months of sweat equity and work ourselves.
Wow. So it took you about 8 to 10 months from the closing until you were able to make this rent ready.
Yes, yeah. So essentially, we were doing it after work. We were doing it on the weekends, the time we could find. So I was still working at Pepsi. My dad was still working his full-time job as well as my mom, and we did it when we could. And so we ended up doing it over those few months, and yeah, got it completely renovated and it turned out to be a really nice property. And so I was able to actually cash out refinance after that. So the refinance aspect.
When you purchased that first property, did you have in mind that it would take 8 to 10 months or were there delays?
Yeah, we didn't really have a timeline. I think ideally we wanted to get it done in six, but we did everything from new flooring, sheetrock, roof, really top to bottom on that house. We even painted the exterior ourselves, which we did everything, and it came out to be a really nice project. And I still have a lot of great memories with my family and thinking back to how that started my whole real estate journey. And it means a lot to me. I still have the property today. It rents out for a great price and there's really solid tenants in there. So it's what started and was the whole building blocks of everything. But yeah, it always takes a little bit longer than you expect, I think, if you're dealing with permitting or contractors. But we're doing all the work ourselves when we can get it done. So Took a little bit longer, but at the end of the day, I was living back with my parents at the time in town. I didn't really have a time frame where we needed to get it done in a certain amount.
What was the amount that the first tenant was paying in rent?
I want to say it was like 1,200. I think my mortgage at the time was only like 795 or something because I had very little amount debt on the property. But when I refinanced, I put 20% down and my mortgage initially, the total principal balance was about 68,000 from what I remember. When I refinanced and got it reappraised, I initially bought it for 88. I got it reappraised for 140,000 after the renovations. And
Wow.
so I took a new mortgage for 112. And so that's what gave me capital again, essentially. Took about $40,000 in cash out from that cash out refinance, which I used to buy my next property.
Was your plan to continue buying more and more, or did you think this was a one and done?
The plan was always to buy more. Once I got the first one under my belt, you get hooked to it. But a lot of people I talk to, or a lot of people in the industry, I guess when they first start is, yeah, I'll buy a single family house, I'll rent it out, I'll buy another one next year, I'll rent it out and repeat. And they start to build a portfolio and they might get two or three houses in and realize that's not really a scalable way to do it. So when I actually cash out refinance from that first deal in that house, I found a 3-unit multifamily property that was put on the market that day. I remember it was a Saturday morning, and I reached out to my realtor right away and I said, "This looks like a great property." The previous owner, was a mom and pop owner, and he owned it for 30 years. It's exactly what you're looking for. First time he put it on the market, I used actually my cash out refinance as a down payment FHA loan to take down that 3-unit. About that, I believe it was 10 to 12 months later that we closed on that.
Was the first property you bought right near where you live, or were you seeking further out?
Yeah, so it was in the Lehigh Valley. It was in Bethlehem. So it's from where I'm originally from. When I bought the property, I was actually living in Harrisburg, but I bought it, so I moved back home, and I was still working for Pepsi at the time. But yes, I was familiar with the market. The market is about an hour north of Philadelphia, an hour and a half, hour and 45 minutes west of New York. So the market itself was growing pretty substantially. There was a lot of development happening, a lot of expansion on the highways, malls, different things that were happening within the valley. And I have been fortunate to ride that appreciation in the value of my property over the last, I guess, 10 years, 9 years since starting that one. But yeah, it's in the town. And so very familiar with the area and the comps and then that's where I wanted to focus on.
Yeah, 2016 was a great time to start
Yeah.
in the business, and you had some upward momentum to help you over there.
Yep. And a low interest rate. I got 3.875 locked on both of them. Now I've
Wow.
refinanced a couple times, but yeah, to have those fixed rates low and you look back now at where rates are, fortunate to have that type of debt on the properties.
Yeah, when I started in 2001. I bought a single family home about 45 minutes from where I live. I live in New York City, and New York City was untouchable. So I was looking at different markets, and I settled on Central Jersey, Trenton, New Jersey. And my goal was to buy just one. I was working a corporate job, and I figured, let me buy one house. I will pay it off over 30 years. And over the next 30 years, with everything being paid off, it would be like a bonus 401k. I could sell it when I'm retired. But after 2 or 3 months of collecting rent, the numbers really just started clicking in my head. Even though I had these calculations beforehand, when you're in it, you're really in it.
Yeah.
And I figured, why not two? Why just one? And I was off to the races after that. And
It's addicting.
oh yes, oh yes. Now you mentioned you're from Pennsylvania. When you started 7P Capital, are you investing in Pennsylvania, or are you investing nationally, or are you picking a few markets? What's your
Yeah. So I guess fast forward, I moved to New York City also.
okay?
I live in Chelsea, so in Manhattan, and moved to New York in 2018. And that's really when I got more exposure to multifamily, commercial, and understanding the world of really commercial real estate, how it's much differently financed, right? The aspects and the underwriting and everything that goes into commercial was far different than what I knew so far in the residential space, right? I was buying the single family, a 3-unit, it was all 30-year fixed rate debt, easy to understand. That's when I really dove deep into understanding commercial, fascinated by how it worked, understood and found out syndications and you can invest in these high quality, large apartment complexes along with other investors and operators. And it really piqued my interest in understanding this is a more scalable way to grow in the real estate space. And so I really doubled down on education, investing into some of these deals myself, getting into a mentorship program, going to UPenn Wharton real estate analysis course. So really just doing everything I could to further educate myself, do underwriting. And it wasn't until 2023 when I realized I could start 7P Capital. I always had a thought about it, but understanding that there's a business there that I have exposure to a lot of these operators and these deals now. And there's a lot of people within my network that ask me, how can I get started in real estate investing? How can I get exposure to some of these deals? What do these deals look like? And how can I get started? And that's what we do today with 7P Capital. So we invest primarily in, so far, most of our multifamily deals are in Texas, so Dallas, Waco, looking at a Houston deal right now. And with strong operators in place, we have operator relationships where we primarily partner with them from the equity side, that we do due diligence, we meet with them, we see deals come across our plate pretty often each week, and we really vet out the relationships, who's running the property, their portfolios, and is this property that we want to invest in? And so if it checks all the box and we do our deep due diligence with them, then we decide to partner with them, determine an amount that we're going to bring to the table from an investment standpoint, and then we bring it out to our greater investment team.
So you mentioned you started 7Peak in 2023.
Yes, correct.
So what was your real estate career like between 2018 and 2023? You moved to New York. Are you still buying smaller properties in Pennsylvania? What does 2019, what does 2021 look like?
Yeah, great questions. So I moved to New York to really accelerate my W-2 career and to accelerate my earnings. I was still looking for properties in Pennsylvania at the time. Being 2 states away, my family was still back there, but it became a little bit more difficult. My thought and intention was to continue to build my own personal portfolio. But once I got into New York, started exponentially growing in my sales career and starting to make a lot more money, that's when I started to really look into the syndication world. And between the 2018 and 2023 was, again, diving into the education and the mastermind and then mentorship and then really the Wharton School, getting educated, and then investing myself personally in syndication deals, as well as some private credit to understand how those worked, reporting, distributions, and really invest in those deals first before I really started what is now 7Peak and help others invest into these deals alongside of us.
Now, 7P Capital, I guess you're a fund, am I correct? And you're raising money from other people in your network, family, friends, business associates, strangers, whoever knocks on your door.
Yep.
And they are effectively investing in you. Am I correct?
Yeah, you could say that to some capacity, correct?
The question is, when you come across a deal, it's in Dallas, it's in Waco, it fits your buy box, are you then taking that deal and telling your black book of investors, hey, here's a deal. I really love it. I'm putting some of my own money in. What are your thoughts? Or are these investors already committed to Bryan Morris, to 7Peak, and whatever happens, whatever the deal is, we're already in?
Yeah, great question. No, they're not already committed. They're part of our investor list. Generally, every week through LinkedIn, I see about 15 to 20 new investor leads that I'll get on a call with. The inbound lead flow is very positive through just leaning into LinkedIn this year as well. But just, again, what you mentioned earlier, leveraging my business network in New York, family, friends, and everyone who knows that I've been investing in real estate. But that's essentially it. We strive ourselves on being as transparent as possible and as available as possible to our investor base and doing the upfront work to really unlock these opportunities for those people that are interested in getting into institutional, high quality real estate deals and assets. Now, we've met with operators and meet with operators continuously all the time, understanding what's your portfolio look like, what's your track record, how is it performing, how many units do you have under management, where are your properties. We're going to a lot of events. We go to 3 to 4 events around the country each year to really meet in person and understand these. There's a couple operators here in New York that we're close with that have events that we're actually going to next month. And so we really want to build on those relationships because the people that we work with and invest with us primarily are high net worth W-2 professionals that are busy, that are very good at their jobs, that make good money, that have a family at home, and they simply just don't have the time to go out and find quality real estate deals, or they live in New York and they can't go out their backyard and buy their own rental property or buy their own duplex, and they just can't fit in their schedule with their family and their job that they're quite frankly very good at and making a lot of money. So they're looking for opportunities to diversify into real estate, and that's where we can come in and help. And we pride ourselves in doing that upfront due diligence and try to bring forth the best opportunities to our investor base. And we try to get into about 3 to 4 multifamily deals per year. And then this private credit fund is now an open-ended credit fund where they can continuously invest in. And both strategies are a little bit different, but those are the two offerings that we primarily offer.
When you say a private credit fund, are you guys investing in debt or in the equity portion of the purchase?
Yeah, great question. So it's debt. We're lending first position about 40 to 60% loan to value.
Got it. And with the private equity, with the debt, you're also working with operators, lenders, direct lenders who their business is to find the borrowers, underwrite the deal, make sure, all the I's are dotted, T's are crossed, and then you're coming in for a part of that loan. Am I correct?
Exactly. Yeah. So they're going to originate the loan, right? They have the systems in place essentially to originate and to lend out the money. And we provide capital within that fund where we're seeing the interest return on that, and essentially acting like the bank within that debt fund, which is a bit of a different strategy than when it comes to the equity investments.
And these are primarily bridge loans, I'm going to guess,
Yeah, they're short term, 3 to 36 months, typically paid off in less than 12 months.
with 8 to 15% type of interest rates, or
Yeah, we're seeing through our partner about 14 to 15% a yield on that.
got it. Got it. Okay. How are these deals structured on your end? Just to give an example, let's say somebody's coming to one of your partners, your operator partners. They need to borrow $15 million for a bridge loan. All the check boxes check, a good borrower, good background. Your operator partner needs to come up with $15 million. They reach out to all their investors. Seven Peak decides that we can come in for 500,000 or $1 million of it. Does each investor of yours have separate relationships now with your operator, or is everybody coming into Seven Peak Capital and Seven Peak Capital is just writing one big check and the returns come that way as well?
Exactly. Yeah, it's a SPV. So everyone's coming into the 7P Capital, and then we're writing the check to the operator. So for the example that you just used of the private credit fund, there's about $150 million across 63 loans within the fund that we're working with our partner. And so they continue to recycle the capital that's in there. I believe last month there was about $20 million of cash, and the rest is loaned out right now in different loans. But that's exactly right. We'll go in and we will invest capital into the fund. They'll continue to originate loans and recycle that capital to provide us our returns. And then they're on a capital call structure right now. So they'll call capital from us and give us a date 45 days in advance. We'll go out to our network and say, hey, the next capital call is October 1st. If you would like to be part of this round, we need to have funds in by September 25th. So they will reach out to us. If they're interested, we sign the paperwork, the subscription agreement, and they get into the fund and they have exposure that way.
Now, when someone borrows on a bridge loan, besides the 10 or 12 or 14% that they're paying on the interest rate, there's other fees. And I'm not talking about appraisal and environmental and all that. There are fees such as points on the way in, sometimes a point on the way out. Does your network share in that, or is that strictly for the operators?
That's a great question. That's strictly for the operators, since they're doing the work on that side of things to originate the loans, to market and get the leads, quite frankly, for the loans, and then to write it and do the work. They're seeing those fees into their fund. The way ours is structured is we do a 10% preferred return to our partners in the fund. And then there's a class of 60-40 split thereafter of profit sharing. So the investor will see 60% and then we'll see 40% thereafter on a performance basis, but no upfront fees, no A fees, and no capital placement fees.
Okay. What about on the equity side? Besides a private credit fund, are you investing as equity into deals and enjoying potentially some of the upside and tax
Yeah,
benefits?
that's exactly it. So everyone's excited about bonus depreciation being back. And so, yes, the equity deals, you'll see a 7 to 8% preferred return and then an 80-20 split, right? Something similar to that, where that's exactly it. We may be bringing $1 million to $2 million per deal into these equity deals. And sometimes we negotiate co-GP, or sometimes it'll be through a feeder fund structure. But our investors will get benefit and exposure into these deals. And one thing I didn't mention about the private credit fund with our operator, the benefit that our investors receive is not only exposure to an institutional quality fund, been audited by Deloitte the last 2 years, really high quality. The minimum check size to go directly to that operator is $1 million. So we're able to get our investors in who might be writing $50,000 checks into a fund that's institutional quality and exposure for them, but they might not be family offices or the super high net worth that are writing the $1 million checks or more.
These funds are giving 7P Capital a K1 at the end of the year, an annual K1.
Exactly.
And then what are you doing for your investors? You have to, on your own, give individual investors a K1?
Correct.
Okay, so you are incurring some costs involved in operating this fund.
Yeah. Yeah. We have a portal. We have our investor portal. We process K1s with our CPA. So yeah, there's some ongoing costs. And yeah, we don't charge any fees, like I mentioned up front, but the profit sharing split thereafter, the preferred return is where we make some of our profits.
Now, you've been with Salesforce for quite some time. Salesforce is one of the largest companies out there in the world, very successful. Do you feel that being at Salesforce, working your W-2 job, and I'm not talking about necessarily the amount of money that you're earning, do you feel that this helps you with your network of investors? Meaning, if you were to give it up, do you think you could raise more money from investors and do more deals? Or the fact that you have access to coworkers who
Yep.
are making, I guess, just as much money as you are, who are very busy, who want to invest, does it hurt you by staying at Salesforce, or does it help you by staying at Salesforce?
Yeah, it's a great question. Salesforce has been an amazing company. I've been here for 3.5 years, and I have a great team of coworkers and colleagues. And there's 70,000 plus employees at Salesforce, and I work in the New York office. So I think very much so that it helps me. I share what I'm doing on LinkedIn openly. I post 5 times a week. I love to share my story of just all the lessons I've learned over the last 10 years, good, bad, and different, what I would have done differently, what I would have doubled down on, or what's done very well for me. And so a lot of people within my network and within Salesforce that I'm connected with have come to me on Slack, have asked me questions and say, hey, I've seen your posts about real estate investing and it's really piquing my interest and I'm really interested. I'm a big proponent on you don't have to quit your job until you really feel like that's something that you want to do. If you can balance both, like I mentioned earlier, I work with people that are very successful at what they do, very good at what they do. And they might love it, right? They may love, and it might not just be in tech. It could be your attorney, your dentist, your doctor, but they do very well at what they do, but they want exposure to real estate. They just don't have the time. And when they do have the time, they don't want to take it away from the family because they want to go home and actually relax and spend time with their kids. So that's where we fit into the mold is we have relationships. We have a Rolodex of operators and partners that we work with that we can bring them deals every quarter, maybe every month that we see or we want to partner on. And I think having the relationship and the network within Salesforce and just the W2 world, not only allows me to bring more contacts into our investor network, but also allows me to continue to fund my own investments. I make a good earnings in Salesforce, continue to grow what we invest in with 7P Capital.
Why do so many people out there always talk about leaving their W-2 in order to get into real estate? Now, we could say that maybe their W-2 is paying $70,000 a year, and by default, they hate their job. So if they could replace the 70,000 with 70,000 of passive income, it's a real win.
Yep.
Besides earning nice money, I'm assuming you really love the job.
Yeah, Salesforce again has been amazing. All right, the mix, the coworkers, the people I'm surrounded with, the culture, everything about it, I couldn't speak more highly about. And then outside of the week to week, day to day stuff, like I have the autonomy, the flexibility to meet with operators, do real estate and review real estate deals. I'm in office a few days a week. I'm working from home a few days a week. And I post on LinkedIn, like I mentioned, about building 7P Capital. That's essentially what I've been posting about on LinkedIn since January for the last 8 straight months. And no one in Salesforce has mentioned anything. That, quite honestly, they've been coming to me and saying, "This is awesome. I'd love to see what you're doing outside of Salesforce, and you're building this real estate firm and investment company, and you're getting into deals." And so I've gotten a lot of positive feedback. So yeah, Salesforce has been very supportive and a great company to work for while I continue to invest.
The founder of Salesforce, that's Mark Benioff. Am I pronouncing
Yes,
that
sir.
correct?
Yep. Mark
Uh,
Benioff.
has he reached out, or I guess not?
Yeah, he's not, but he's next on the list to get onto the investor list. But I think he's doing pretty well for himself. Self-made billionaire, owns probably about half of the big island in Hawaii, flies on his private jet. No, he's been doing very well for himself, and I've met him once, but he started a company in '99 in his San Francisco apartment, and he still runs it to this day. So that says a lot about him already.
So why is he investing in Time magazine? Did he buy
Yeah.
that, right? I guess it must be a vanity project.
Yeah.
He has a couple of $100 million to set aside for fun. That keeps him in the news. A smaller Washington Post game. But all right, we won't talk too much about him.
Yeah.
He's definitely impressive. But every time I see that they buy these companies, I figure maybe it's just a tax loss and they get to have some fun at the same time. But okay, so he has not invested in 7P Capital just yet.
No, he's on the list.
Okay, but if he does, get him to post on LinkedIn and to tag you there. That's
Right. Bring some inbound leads. That'd be nice.
Were you investing in multifamily deals before you started 7P?
Yes. Yep.
And-
We got to.
How those come about?
I'm still holding a lot of my investments. They're doing well. Luckily, I know there's a lot of tough times for people that got into deals, specifically 2020, 2021, with low interest rates and cap rates were super compressed, and people were paying very high valuations for properties, and rent growth was through the roof with COVID migrations, 20% year over year in some of these markets in Texas and the Sun Belt. And so you hear about all those. Luckily, the investments that I got into have done well and they're performing well. And I look forward to them going full cycle. But that was all part of like me investing into these deals to understand operators, track record, investments, distributions, K1s, right? And getting into those deals myself and starting 7B Capital and understanding the aspect of it behind the underwriting, the analysis, and the educational piece. That's what I wanted to bring forth to my investors to understand what they're getting into as well.
If somebody came over to you and said, "Hey, I have 50 grand. I want to get into real estate. I have a good job, but I have 50 grand. Should I just buy SPY and watch it grow? Or should I just buy a real estate REIT and enjoy some of the dividends? But I want to be in it. I want to have fun. I want to get some depreciation." What's the first step that somebody could do?
Yeah, great question. And I actually love this question. I get it a lot when I first meet with investors that are just poking around. And, what I ask them first, honestly, is you have $50,000. Do you want to be on the active side of real estate investing? Because a lot of people that I first talk to, they think that I might help them buy a single family house, or we might help them get started, or they don't really know how we can help yet. They're like, "Hey, I want to get invested into real estate." So I'm like, "Do you want to be on the active side or the passive side?" That's one of the first questions I ask. And being active is, hey, looking for a rental property, finding and putting a down payment on that property, finding a tenant, finding a way to manage it. If you're in a market that you can do that, or looking out of market. Now, if you don't want to do that, I would recommend doing due diligence and learning what else is out there from a private placement standpoint, which a lot of these multifamily equity deals, and there's other asset classes, right? There's self-storage, there's RV parks, there's mobile home, there's industrial, there's retail, there's all types of commercial real estate that people can invest in and see depreciation benefits, tax benefits when it comes along with that. If they don't want to go the active side and that's not feasible, they're in a market that doesn't make sense, or they just don't have the time, then I say, let's start educating and looking at what options you do have from a passive standpoint. And so, go ahead. That's generally the process that I take the investors on to understand like what their options are from there. And then we continue the conversation around more passive investing into commercial assets.
When you're investing in debt, so you're not on the equity side, are you still locked into certain markets in Texas, or once you're investing in first lien positions on property, as long as the LTVs are safe, are you more open to different areas and different locations?
Definitely. Yeah, we've lent within the fund to 17 different states.
Got it. Well, multifamily?
No, it's a mix. Multifamily has the biggest mix within the fund, but it's about 25%.
Anything in New York City?
Not New York. No.
Are you afraid of New York, or you just haven't had the opportunity?
Don't think we're afraid of New York, but we want to invest in states that are friendly enough where foreclosure laws are in our favor. So if we are first position, which we are, 40 to 60% is a typical loan to value range. So for example, if there's a $10 million property that they're looking for a 12-month bridge loan on, and we give them $5 million as a first position, and they can't pay us back. Now, out of the 64 loans, there's been 3 that have come up to a position where they were going into default. The one we actually took back and resold for an 18% profit. The other 2 were refinanced. So we're in a position where we do have an equity buffer that if we were to take the property back, that we own now an asset that we had buffer in due to the value. But there's a process, right? A foreclosure process, and we want to ensure that is a swift process that we can go through if necessary. But prior to that, there's a deep due diligence process of who we're lending to. And I think that's a reason why there's been such a low amount of delinquency, that we have very much confidence in our borrowers that they can pay us back at the rate and then move on to more long-term financing for themselves.
Just to back up, you mentioned a deal that didn't go as planned. You guys had to take back the property. When you say an 18% profit, you're talking about a profit above your loan, not on the value that the property was appraised for upfront. Am I correct?
Exactly. Yeah.
And are you selling the actual property? Are you selling the note? What are you doing?
Yeah. That property specifically was a construction loan for a residential property in New Jersey. So I think it was 1.2 or 1.4 million, but the property was valued significantly higher. That we took the property back and it was sold in 45 days. And so we got a return on our capital invested.
Got it. And this is a property that was still in the middle of the development stage. So the bank is not, your operator is not actually collecting rent for those 45 days and dealing with tenants. Am I correct?
Correct.
Okay, so that's not bad. The reason I asked you about New York City is I always say I'm afraid of New York. And I think I need to just add a caveat where I'm afraid of being a landlord in New York. Holding your first position lien, especially with lots of protective equity, a 40% or 50% LTV. In New York, I think I'm okay with that because
Right.
New York has great value, lots of buyers willing to buy here. But I just don't want to be a landlord here in New York. And I'm born and raised here in Brooklyn. I grew up here. I still live here. My office is here. I'm sitting in Brooklyn right now. And for the most part, I don't invest in New York City. I own my house. I own my office building. I happen to own another piece of property just nearby my house. But I've been out of New York since '06. And I started in New Jersey in '03, in '01. In '03, I started buying some smaller properties in New York. And while I did well with the appreciation,
Mhm.
but being the landlord was just so tough. And this is way before all these new laws came with
Right.
2019 and all that. You have what we call them professional tenants
Yep.
who can live in a property, not pay rent for 2 years, and then still get almost paid off to leave, get their moving expenses, cash for keys. It hasn't happened to me, but I've seen it happen many times across the board.
Mhm.
And I had some Section 8 tenants, and I had tenants just to spite me, even though they weren't paying. It was Section 8 paying. They would call in a complaint just about every couple of weeks just to have the Section 8 check stop coming. And they would call for some chip paint or the screen didn't close. And they would strategically call like every few weeks. Instead of all in one shop, they would do it every few weeks. And that to me was the biggest turnoff. Not that New Jersey is so much better, but compared to New York, it's tons better.
Yeah.
In parts of New Jersey, you could have a tenant not pay rent, and within 3 months, they're out. These days, I'm buying multifamily in the Cleveland suburbs and in Louisville, Kentucky, which I guess these are considered red states, although the cities itself are considered maybe a little blue. But compared to New York, it's like the Wild West, and it's great. But
Yeah.
being a landlord is just a real tough business. And I understand why you're investing in private credit, because you don't have to care if the toilet flushes or the person pays rent. It's, I'm the bank, pay me, and that's it. And I guess you give up some of the upside,
Right.
but the operational and just the mind space is really just clear. The payment is due. You don't care what happens. I don't care if you collect rent. I don't care if your construction is taking longer than it's supposed to. My payment is due on the first of the month, and that's it.
That's exactly it. Yeah. And it's a different strategy than equity for sure when it comes to owning and operating is a whole different beast in itself. The real job starts is when you close on the property and you have to operate it, right? And being in real estate, I'm sure you know that, but that's very true on the debt and private credit side is being the bank, your first position. If they don't pay you, you take it back. And you do give up the equity upside and the total appreciation, but you have this fixed income that, you're set to earn based on your position within that loan. So I think there's a good mix of both depending on what your strategy is. If you want to diversify, I have holdings in both, and I think it's important because I feel like within my portfolio, I still want to diversify into a handful of equity deals every year, right? To get those appreciation benefits, to offset that rental income and passive income that I'm receiving. But also, I want that credit debt income that is consistent, right? That, like you said, you don't have to worry about, right, the inconsistencies and the management operational headaches that could come along with that. Again, two different strategies, but I think it's important to diversify into both if you can.
Brian, what do you do for fun in Chelsea?
Yeah. I like to get out golfing when I can, but it's not the easiest when I live in New York. But my wife Jenna and I have been in New York since 2018 and in Chelsea specifically since COVID. So we did live through COVID, through the whole pandemic, and I'm sure you did too, being a New Yorker. We love to go to the restaurants in New York. It's some of the best dining you can see. I like to run a lot. I'm training for the New York City Marathon actually in New York, November 2nd this year. So it's going to be my first time running it, but I'm super excited about it. I played collegiately football and baseball. I played a little bit of professional arena football after college. I've always been wanting to move, work out, and keep up with that now by golfing and running and working out during the week.
I don't play golf, but I live in Brooklyn, and less than a half a mile from my house is a golf course. And people
Really?
are shocked when I tell them, yes, there's a golf course less than a half a mile from where I live. I live in the Marine Park section of Brooklyn.
Yep.
And there's, I guess on Flatbush Avenue, there's a golf course. I think it's called the Marine Park Golf Course.
Yes.
I live literally less than a half a mile away. I think I went there once, and it was just for the driving range, not for the actual golfing. But I don't know, maybe one day I'll take up golf. But for now, I guess I'll just work on podcasting.
Yeah. Podcasting. And then once you retire fully and give up the real estate and you're living on your passive income, then you can go move on a golf course and play golf every day.
Brian, I had a great time talking to you. I guess you're considered a fellow New Yorker, even though you're born and raised in PA, Harrisburg / Bethlehem.
Yeah.
But you made it all the way to New York, living in Chelsea. Chelsea is the area where the TV show Friends took place. Am I correct? Or am I wrong on that?
Ask my wife because I think she's seen every single episode that they've ever taped. But yes, I think so. They have like on Flatiron, 23rd and Park or somewhere there in Flatiron, they have a whole Chelsea or Friends experience and everything. Yeah. And then there's Central Perk, I think was the coffee shop that they named it.
Yeah.
There's like one
over there,
like an exhibit close by. So yes, I think Chelsea is the spot for that.
Got it. Yeah. I used to work right near the Flatiron building back in 98 till I guess 2000. I was working on Madison and 26th. I was working in the advertising business. I was working in online advertising back in 98. So we're talking pre-Google, where ads back then was just these big banner ads on the homepage of Yahoo and Excite and Lycos. You might be a little too young to remember those. AltaVista.com and all these companies that are really no longer. But yeah, it's a great area. We're glad to have you in New York. Bryan, tell my audience how they can reach out to you. I'll put it in the show notes, but just give your phone number, your address, your whatever you want to share.
Social security
Social,
number.
right?
Yeah.
Yeah, sure.
So the best way to find me online would be my LinkedIn, Bryan Morris. You can go to sevenpeakcapital.com. You can send me an email at Bryan, Bryan, at sevenpeakcapital.com. Or you can reach out to me personally. My cell phone's 908-227-6866. Feel free to shoot me a call, shoot me a text, an email. I'm always happy to talk to any current investors that are looking to diversify or people that are looking to get into the business where I can help maybe offer some guidance or some advice.
Okay, Bryan, thank you very much. I appreciate you coming on. I'm going to put everything you mentioned in the show notes. That's it for today's episode of The Wealth Clock with Steven Weinstock. If you enjoyed this conversation, make sure to follow the show so you don't miss the next one. As always, you can find my contact info in the show notes and on my LinkedIn profile. Thank you for listening. Bryan, thank you so much.
Thanks, Stephen.